Climate change significantly influences investment strategies across various sectors and asset classes, prompting considerations for both risk mitigation and opportunities in sustainable investing. Here are key impacts of climate change on investment strategies. Physical risks. Asset valuation. Climate-related events such as hurricanes, wildfires, and flooding pose direct physical risks to assets such as real estate, infrastructure, and agriculture. Investors must assess vulnerability and potential damages when evaluating investment decisions. Regulatory risks. Policy changes. Governments worldwide are implementing regulations aimed at reducing greenhouse gas emissions and promoting sustainability. Investors face regulatory risks related to carbon pricing, emission standards, and renewable energy incentives impacting industries like energy, transportation, and manufacturing. Transition risks. Market shifts. Transitioning to a low-carbon economy involves shifts in consumer preferences, technological advancements, and market dynamics. Investments in fossil fuel-dependent industries may face risks from declining demand, stranded assets, and shifts towards renewable energy and clean technologies. Investor preferences. Sustainable investing. Growing awareness of climate risks has spurred demand for sustainable investment strategies. Investors increasingly integrate environmental, social, and governance (ESG) factors into their decision-making processes, favoring companies with strong sustainability practices and climate resilience. Financial sector impacts. Insurance and reinsurance. Insurers and reinsurers face increased liabilities from climate-related claims, leading to higher premiums and adjustments in underwriting practices. Financial institutions assess climate risks in lending decisions, portfolio management, and risk modeling. Opportunities in renewable energy. Clean technologies. Investments in renewable energy sources such as solar, wind, and hydroelectric power present opportunities for growth and innovation. Renewable energy infrastructure projects and technology advancements offer potential for attractive returns amid global efforts to decarbonize. Supply chain and operational risks. Supply chain disruptions. Climate impacts on supply chains, including disruptions in agriculture, transportation, and manufacturing, affect operational efficiency and costs. Investors evaluate companies' resilience to climate-related supply chain risks. Disclosure and reporting standards. Transparency. Increasingly stringent disclosure requirements and reporting standards, e.g., Task Force on Climate-Related Financial Disclosures, TCFD, enhance transparency around climate risks and opportunities. Investors seek comprehensive climate-related disclosures to assess investment risks and align with sustainability goals. Long-term economic impacts. Macroeconomic stability. Climate change poses systemic risks to global economies, including shifts in productivity, resource availability, and geopolitical stability. Long-term investment strategies consider climate scenarios and their implications on economic growth and financial stability. Engagement and advocacy. Stakeholder engagement. Investors engage with companies, policymakers, and stakeholders to advocate for climate action, improve corporate governance, and drive sustainable business practices. Active engagement aims to influence positive environmental outcomes and long-term investment performance. In summary, climate change reshapes investment strategies by influencing risk assessment, regulatory environments, market dynamics, and investor preferences towards sustainable and resilient economic practices. Integrating climate considerations into investment decisions is crucial for navigating evolving market conditions and contributing to a sustainable global economy.